Hey, good afternoon, everyone. Thank you for joining us. I'm Mike Sadek. I'm the Managing Director of Retail Trading at Lightspeed. And we have Pete Renzulli, the Director of Education at T3Live.com with us today. Pete is actually filling in for Evan, who was originally going to do today's presentation, but unfortunately he got a little sick. So this is going to be a great webinar. Pete will be discussing some specific strategies that have proven successful with active traders. Just a little background on T3 Live. They are one of Lightspeed's educational partners, and they provide a wide range of trader education, including on-site training classes, blogs, videos, online courses. But I think the most unique tool that they offer is the T3 Live virtual trading floor. And what the virtual trading floor does is it allows individuals who are trading from home to run an application on their desktop where they have live access to commentary and real-time trades and positions from some of the best traders in the business. You can watch and listen as these professionals are trading throughout the day. And I think it's really the closest that many people can get to actually sitting with these professionals on a trading floor. So before we start, just a few quick housekeeping items. Please keep in mind that this webinar is for informational purposes only. So nothing we present today should be construed as investment advice or a recommendation by either Lightspeed or T3 Live to buy, sell, or hold any specific securities. So again, the strategies presented today are not recommendations, and they may not be suitable for you based on your own investment objectives. So always consult an investment advisor before you go making your own investment or trading decisions. And as all our webinars, this presentation is going to be recorded and uploaded to our website. So if there's anything that you miss or you need to cut out early, you can always come back to lightspeed.com/webinar and view the uploaded recording. And of course, we want to keep this interactive, so we encourage you to ask questions as we go through the presentation. In your webinar console, you'll see a little chat box. So if you have any questions as we go through the presentation, just type them in, and we'll try to pause throughout, take some questions. Or if you prefer, you can just wait till the end, and we'll do a Q&A session. So, Pete, I'm going to turn it over to you.
All right, Mike, thank you very much. A little bit about myself. My name is Pete Renzulli. I've been in the business for quite a bit now. I've been trading commodities actually since 1994, full-time trading stocks since 2000. Actually started out trading for the Attain ECN, which was eventually bought out by Direct Edge. Trading for the ECN gave me a very unique insight into the inner workings of adding and removing liquidity, and ultimately ended up where my style of trading now is a little bit longer term intraday position trading. Every once in a while holding overnights, but more so intraday. I think with the amount of headlines and headline news that we've had specifically over the last 2 years, and more specifically with all the stuff going on in Europe right now, the overnight risk has been a little bit more increased than it has ever been before, and I guess this morning's price action will attest to that, closing on the highs yesterday and then having the type of opening that we did today. Mike, I just want to discuss or touch on something briefly there. You mentioned education there 2, 3, 4 times. It's very interesting where education comes from and how each individual trader ultimately ends up learning. And whenever I work with traders in our private mentoring or just doing mastermind groups or that kind of thing, one theme that most traders absolutely have to recognize is that the most valuable trading book they'll ever read is their own trading journal. And I think most traders take that for granted, that their own individual experience has to be something that will ultimately form their trading plan. We're going to get a little bit into a couple of the strategies. You can see here on the screen it actually says Part 4. These are a couple of strategies that are from our Active Trader manual. But what each individual trader needs to know is they need to learn in different market environments and ultimately make whatever education they get their own. So we're going to talk about a couple of strategies today, but what I really want to stress to everybody today is you must write key observations down during the trading day, or if you're not an active trader, from day to day or week to week, of price action scenarios that repeat themselves. And ultimately what will end up happening is you will eventually gravitate, whether you're holding a trade for a day, an hour, or 3 weeks, you should, if you're taking good notes, eventually gravitate towards a strategy and a style and ultimately tactics to enter and exit the market that you're comfortable with. I think one of the things that most traders get lost in, and where they probably extend their learning curve a little bit too far, is they want to be good at everything. and they'll have an irrational passion to want to keep learning more, and there's nothing wrong with that. But eventually you have to get to the point where you say, you know what, that one makes sense to me. That strategy makes sense to me, or that tactic makes sense to me. That way of looking at the market, combining it with the stocks and that kind of thing makes sense to me. So if you want to cut your learning curve down, there's a couple of things that you need to do. Number one is you need to try a few different strategies over time and ultimately come up with one that makes sense for you. But you have to be very conscious that you can cut your learning curve down drastically by taking really good, diligent notes of what makes sense to you, and you'll know what does or what doesn't based on whether or not you're comfortable with an idea, or comfortable with a risk, or comfortable with a type of entry pattern. And ultimately, it's interesting because I define education as making this big list of what doesn't work, and then you have these strategy and tactics that's much smaller and what eventually does work. And it's kind of fascinating that most of trading is and really, I don't want to say elite trading, but consistent trading that's less stressful. It's really about minimizing mistakes or minimizing getting involved in the market by staying away from scenarios that don't match your strategy. And I think a lot of traders have the sequence backwards, where they look first for the tactics, or what we call the entry patterns, and then hope the market conditions come along and give the big push for their strategy or their tactic to work. And the sequence really has to be the other way around, where the quote that we use a lot is pick a side and then pick a spot. So we're going to talk about a couple of entry patterns here, but it's very important to understand that the strategy comes first, and then the tactics to get involved into that strategy of whether you want to be long, short, whatever it happens to be. The strategy is first, the tactics are second. So if I could just sum that up a little bit, don't take for granted how important your own experience is, and make sure you journal prior to putting a trade on, your thoughts and actions while you're in the position. And again, it doesn't matter if it's an hour or if it's 3 weeks. Write down the observations and what you're focusing on during the trade, and then after the trade, how you react to whether you made money on the trade, didn't make money on the trade, and that kind of thing. And if I could just touch on that even one step further. Good professional traders, which I define as somebody who earns money and earns money consistently, okay? Focus on the process of trading well, which means that you need a process in the first place that you can execute on a consistent basis. Newer traders, and I'll define a newer trader as somebody who's trading, let's say, less than a year or even 18 months or less, and does not have the consistency in their approach to the market and in their results that they would obviously love to have. Newer traders focus on the results of whether or not every single trade made or lost money. And that will put a tremendous stress on you as a trader and stunt your learning process if you're always focused on the results. And we're going to get into a strategy in a second here, or a tactic, and I want to briefly finish up with that point. If you have two exact entry patterns right next to each other, you have one at 10 o'clock in the morning and another one a week later, whatever it happens to be, the same exact pattern, you cannot guarantee how the follow-through on that pattern is going to be. It could be perfectly moving in your favor once and then perfectly moving against you, but the same exact trade. Your focus should be on whether or not you did what you were supposed to do and let the result take care of itself. So I want to summarize that so you can write it down, so you take it and put it on a Post-it pad on your monitor tomorrow. Good, consistent earners as traders focus on the process of flawless execution. Inconsistent traders focus too much on the results of every single trade. So if you focus on being good, the money comes from being good. So to take that a step back, which leads us into this presentation, first you need a strategy with tactics, and then your skill level will be dictated by how good you follow your plan flawlessly. So it's very, very important to make sure you have that sequence right. It's the process of trading well that produces the consistency. So please keep that in mind. It's one of the things that I can impart from my trading experience, and I like to joke around with everybody. All these lessons and manuals and kind of stuff that we talk about, they all basically come from experienced traders and what didn't work for them, and you make a big book of what doesn't work, and then you get to, the smaller book is, okay, this is what does work. So stay away from all that other stuff, and then focus on this a little bit.
Yeah, Pete,
right,
thanks for stating that. I think that's a very important distinction you made.
Okay, excellent. Again, Mike, if anybody has any questions and you want to shoot them in there, just feel free to let me know. And as we get on with the presentation, we'll take it from there. All right, so the first, the disclosures that we have to have up here, which Mike pretty much covered, but I'll leave that up there for a second. Again, we are here to discuss some ideas, exchange ideas, and not really speak about anything specific as far as what do you think about this particular stock. This is all about learning from each other and the strategies and tactics, and hopefully have something you could actually take into the market tomorrow. All right, so first we're going to talk about one of the most common setups in the market today, and it's using moving averages. Now, one thing I want to point out that when I do my game planning meeting in the morning with my private mentoring clients, the most important part of the day is game planning and getting prepared for the day. Now, if I could just give you a little bit of a something to think about. In the computer-driven age that we have today, moving averages on charts, no matter what software you use, they just become so cliche. They're still powerful if used properly, but sometimes you need to look at a chart and imagine there's no moving averages on there. It's very easy to say a stock is above a moving average, below a moving average, and say it's a long because it's above, but it could be in the middle of nowhere if you took the moving averages out there and you look at the price by itself. So when you're looking at moving averages, make sure that there's a directional bias to the moving average for you to have an opinion that you want to be a buyer or a seller of that stock. So when you do your game planning or you're looking at a stock and you want to say, this is what I believe about that stock right now, if you're not sure or if it's hard to find, it's not there. Okay, if you have to work really hard, it should be obvious. It should be an obvious bias to where you could look at somebody sitting next to you and say, it's obvious that buyers are doing something right now, or it's obvious that sellers are doing something right now. So when we cover this topic right now on using the moving averages, it's very important that you realize that they are a tactic within your strategy. And something else that's very important, we're actually going to get into, actually you can see here the setup. Moving averages are probably one of the first things that people learn when they get involved in the business. Now, I'm going to ask you to write down what was one of the single biggest mistakes that I made when I first started trading. It was you would read the book, you open up the trading book and you go to page 72 of, oh, there it is, that's when you get in. If the stock pulls back to a moving average, that's where you get long. So you can actually see here on the setup, moving average buy is a trade with the trend. So obviously that means what I said before, we actually have a bias to the moving average. Traders view a rising moving average as potential support. Now here's the whole key here. Potential support. This is what I would like for you to write down. Moving average areas, regardless of what moving average you use, they are areas to anticipate something happening. They are not a license to just get long or short or get out of a trade because you're at the moving average. So what I want you to write down there is moving averages are areas to anticipate something happening in price action. And we'll get into what that means in a second. Don't just blindly get involved because it's at a moving average. As we see in today's price action, it can go a lot further than you expect, and you want to make sure you get involved after price action confirms the area that the moving average might be telling you to take a look at it now. All right, so the requirements for a simple but very effective moving average buy setup. Number one, the stock is rising, and as you can see here, the choice of moving averages that we use at T3 are 8 exponential moving average or 21 exponential moving average. As a matter of fact, we use both of those on all of our charts. Now, if I just take a step back there, one common question that we get is exponential moving average versus simple. If you're not sure what the difference is, essentially exponential puts more emphasis on the most recent price action. So essentially what that means is simple moving averages, add them all up, divide by whatever that number is. So if it's an 8 moving average, you divide by 8 closes in a row and you get an exact average. An 8 EMA or exponential means that if it moved faster recently, it's going to give more weight to the most recent price action. Now, which one is the correct one to use? I have to be honest with you, you could use either one. When stocks are volatile, the exponential moves much quicker and you'll get a different reading. Neither one is right or wrong. What I would recommend using is one that you're comfortable with. Some people love the exponential, some people love the simple. Don't overthink it. That's the point that I'm trying to make. Just pick one and be comfortable, but don't change going back and forth because then you could drive yourself a little bit crazy. It's like having two watches to tell what time it is. Pick one and stick, and stick to that one. So the key here is rising, and they're both rising. Next step, we want 3 or more consecutive lower highs and lower lows on the candlestick charts. And we're going to take a look at what that means in a second. Now the key here is 3 or more. You want to get a little bit of price action moving against those rising moving averages so you can measure your risk. That's the whole point of waiting for a pause. You want to be able to measure your risk. All right, next, stock is at or close to one of those moving averages. Now, again, something that we can take a little bit further than just what we have on the PowerPoint here. If you choose to use an 8 and a 21 on the same chart, if 8 is holding above, if price is holding above the 8 with consistency, your trade expectation for follow-through should increase. That means in the case of a rising moving average, institutions are supporting higher prices, and the stock itself can't pull back because they're supporting it. So just the fact that price is holding above an 8 and cannot pull all the way back to the 21 is telling you something significant is happening. So another powerful way of using a moving average in a simple manner. All right, what would the entry be after this pullback? Okay, the entry would be after anywhere 3 or more consecutive candles that pull back would be 1 cent above the previous candlestick's high. Now, a question we get all the time, does that include the wick? It absolutely includes the wick. So the wick you'll see on a candlestick chart where there's the body, which is the color, and then above or below you see that little line, that's the wick. So you will be using the wick as a entry point. Or you could enter on what is known as a Fibonacci retracement from the bottom of the tail, and the tail is also the wick. Okay? All right, so what would the stop loss be? Now, the stop loss is relative to the volatility of the stock. Everybody who's trading a little actively now knows that there's tremendous volatility. Stocks that have gone from where they would move maybe $1 average in a day, those same stocks now, with all the news and headlines that are going on right now, they probably doubled quite a few of them of how much they normally move. So 1 cent underneath the pivot low, which we'll show you what a pivot looks like in a second, is something you have to adjust how far under that low based on how much that stock is moving right now. Now, just as a general rule, the more volatility, the more you want to trade probably a little bit less shares and give the stock a little bit more room because of the increase in volatility. Now, here's why you want to do that. When you become proficient, when you become better at putting together good, solid trade scenarios, you want to earn money on those scenarios, which means that you have to allow the idea to play itself out without taking too tight of a stop loss, where your stop loss is within the normal movement of that stock. So you can see here what's interesting. One of the points that I made on this particular chart here, you can see price action stayed above the 8-period moving average the entire time, which, as I said, if it can't pull all the way back to the 21 and is comfortably holding the 8, institutions are supporting, in this case, higher prices, so your trade expectation would go a little bit higher. Now you see the 3-candle pullback here. That's the 3 or more consecutive, as we have there in number 2, lower highs and lower lows, and that actually does include the wicks there. The entry would be above the prior candle, which in this case is when we start to trade back above, and the stop loss would be below that 3rd red candle there. So again, whatever the dollar amount is, you might want to increase the 1 cent stop loss just based on the volatility. You want to make sure, if you do a good job of picking out ideas, you want to make sure you get paid on the most, or give yourself the best chance of getting earning money on a good idea. One of the most frustrating things for traders, and I went through this when I first started trading, I'd go home every day and I'd be like, I don't understand. 4 o'clock, 5 o'clock, I'd pull up my Lightspeed charts, and I'm like, everything I looked at today, or most of it was great, but I didn't make as much money as I should have. And it ultimately boiled down to going into my trading journal and very diligently saying, that's what's going on. I'm trading too many shares and my stop loss is too close. So I decreased my share size. When the volatility increased, I increased the width a little bit of the stop loss so I wasn't in the noise, and then gave those ideas a little bit better chance to play themselves out. Now, something that's interesting is there's a big difference between being stopped out on a trade and the trade not being valid anymore. So as a part of your trading strategy, make sure that you have something in your strategy to determine, if I got stopped out, is the idea still valid? Because getting stopped out doesn't mean the idea is not still good. So make sure that's a part of your strategy. Okay, moving on to the next slide, we're actually going to get into a couple of more pictures. And the pictures we're going to look at now are a little bit different than what we looked at before. This particular instance in Las Vegas Sands here on a 3-minute chart, what's interesting here is we had a really big push up off the open, and then instead of pulling back, the stock actually traded sideways instead of pulling back, and you can see the 8-period moving average eventually caught up. We had a big tail, which we know now is the wick, did not close below the 8-period moving average, and eventually we got another push off of there. Okay, so there's two types of consolidations that you could look for your entry on a moving average pullback. The faster the moving average, this price moves up off the moving averages, more often than not, you'll get some kind of sideways move into those moving averages, and it'll catch up. If you get a nice clean pullback, then you use the scenario that we discussed in the previous slide. Okay, something similar here on a little bit different time frame. This one actually represents a 15-minute chart, but also very similar. So we're actually introducing here, without it actually being said on the slide, two different types of ways to anticipate using a moving average for a possible entry point. The first one we described, it pulled back cleanly, 3 to 6 candles or 3 or more. Now you see when there's a significant sense of volatility to the upside or to the downside, more often than not, you have to wait for the moving averages and the price action to catch up with each other. And then, as I said before, that's an area you would anticipate looking for your next entry. So that's what you want to write down. The more volatile, away from the moving averages, let the moving averages catch up, and you'll most likely get a sideways pause. If it's a nice orderly move up and a pullback, then you can get involved in what we call a pivot low. And one thing interesting, too, that I'm sure all of you are very well aware of, is kind of like technical analysis 101. The lighter the volume during the pullback or pause, the higher the likelihood of follow-through. Okay, so you can clearly see here during the two pauses where we pushed up and then slowed down, the volume decreased dramatically. And you go to the second chart, pushed up, volume dried up, and then eventually the buyers came back in and pushed the stock higher. So two very clean descriptions there of decreasing volume during a pause, which is a tactic that you want to see when a price action pushes up and goes sideways. And Mike, if you have any questions, feel free to just jump in here and I'll be more than happy to go over them. All right, next we have another moving average buy, and this one's on a 5-minute chart. Oh, excuse me, 5-minute chart here, and this is Wynn Resorts. Now, as you get a little bit higher in the volatility, you'll start to see that some of the stocks have a little bit bigger swings. You can clearly see here in 1/2 hour to the other one, we had almost a $2.50 move versus a stock that's 50. So obviously, as you get higher up in price, you're going to have to adjust for the volatility of those stocks. All right, so on this chart here, you can see we have the 8 and the 21 like we did have on the other ones. And we've also added the 200. Now, the 200 to many traders, if you've read any technical analysis books or really even in investing, take a longer time frame, the 200-period moving average on whatever time frame you're looking at is more often than not the line in the sand for it to be a longer-term bullish or bearish move. So pretty much if stocks are above the 200, you should be a buyer. Pretty much, and again, nothing's 100%, you should be a seller if they're below. Now, one thing that's interesting is the further out you go, your hold times should be further. So if you're looking at a 200, it's very difficult to say what one candle did and how that relates to the 200. So as a general rule, the further out you go with your moving averages, the longer you're going to be in the trade, and you're going to have a little bit wider stops. So on this particular moving average buy setup, you can see for the most part, the price in Wynn holds above the 8-period moving average on this 5-minute chart. We have a couple of really clean pullbacks. We have one at roughly 10 o'clock, one roughly 11 o'clock, pretty much every hour. Lunchtime volume slowed down a little bit, and we actually caught all the way up to the 21. But what's most important in this point to be a buyer, the 8 is above the 21, and the 21 is also rising. So in this particular instance here, you're completely eliminating the other side of the market, and to keep your trading as stress-free as possible, you just step back and you say, I'm looking for opportunities to be a buyer. You're completely not even looking at the other side of the market. Okay, and obviously it's a little bit more detailed than that. We can get into multiple time frame analysis and all that kind of thing at a different time. Let's see. Next we have two more moving average buy setups. And again, we're using the buy setups. It's just a lot easier. We don't have to go on the buy side and the short side. That can get a little bit long. Here we have AIG. Right out of the gate, the stock opened up above the 8, the 21, and the 200. Had a really, really nice push up in the first hour of the day. Now what's interesting here is you can see after we had that big push up in the morning, we had a 3-candle pause up there, right up near 34.50-ish area, right up after we had those big green candles that pushed up. Now you could have technically been looking to be a buyer in that area. It just never triggered because remember the entry, it didn't trade above the previous candle, so there wasn't any reason at that point to get long. So you pull back a little bit more, price pulls back below the 8. So now here's the thing that we talked about at the beginning of the presentation. The moving averages are areas to anticipate price action doing something. So if you broke through the 8, the next area to look for would have been support at or near the 21 EMA. And in this case, we actually got it. It pushed down, traded above that candle with the big wick, and that would have technically have been your entry. Below that candle would have been the stop loss, and the first target would have been the high where the price action just came from. So a very clean chart there. But the interesting thing there is that it pushed down, went through the 8, never traded back in the direction of the up move, so you really would not have been triggered there. Next area, again, you're talking to yourself as a trader. Good to do when you want to develop as many if-then scenarios as possible. Pulls back, holds the 21. That's the area you anticipated looking for something happening. The candlestick does give you the entry, and that's the area that you start to look. All right, one more. We have a pretty fast mover here where it pushed up pretty hard within that first 15 minutes of the day. And actually here you can see on a 13-minute chart. Pulls back very quickly, but it only pulls back and still holds above the 8. So what we talked about before at the beginning of the session, as deep as that stock pulled back, institutions were still supporting it above the 8-period moving average. So you continue to look for an entry point at or near the 8-period moving average. And in this case here, you actually do get it. Trades above that red candle. Stop loss would be below that small one. And your first target should always be at the last place buyers or sellers did something significant. So in this case here, it would be the high of the day.
Hey, Pete, we got a quick question that just came in. What do you do if it breaks support and then 10 minutes later moves back above the support?
Oh, that's actually a great question. And actually, I did touch on that a little bit a second ago. One thing that is overlooked by most traders, and when I say overlooked, it's simply because they don't plan to do it, and it's a great question. You have to ask yourself, is the idea not still valid, or did I just get stopped out? If you just got stopped out and the idea is still valid based on your strategy, plan to re-enter on the next entry signal. Very, very important. And just to throw it out, the question that will come back will be, well, what if I don't get a clean entry signal? As a general rule, unless the stock just completely collapsed, but let's just say it goes down, takes you out, and it's still reasonably within the same area, use your original entry price. More often than not, if let's all face it, you look at the charts and you see the setups, and more often than not, you're not going to get the absolute perfect setups. But you can use the price that you were just involved at. So if it's just a matter of, price came down, it's almost like everybody has that, that thing in the back of their head, but like, oh, they knew where my price was. It happens to everybody. But if you know it happens to everybody, just plan for it and say, you know what, I got taken out. I was okay with the risk when I put the trade on, but the idea is still good. So if it starts to trade back in the direction, but I don't get a clean, quote-unquote chart pattern, get back in at the original price. And the spot that the price just pushed down to, that should be your new stop loss because of what I just said before. The last place buyers or sellers did something significant or a significant reference point that you find, get back in at the same price and use the new level where it just pushed down to where you got stopped out as your potential stop. Now, if that's a little further than you're comfortable with, just drop your share size down a little bit so that you can comfortably hold it for that long to allow your idea to play itself out. And if I could just finish up on that point. For those traders that are new or inexperienced or haven't experienced it yet, it's very, very important to learn, for lack of a better way of putting it. Expect that to happen. Expect that to happen. Because a lot of traders when they first start out, they're like, oh, breakouts don't work. Oh, that flag doesn't work. Oh, ascending wedges don't work. I have news for you. It doesn't have to work all the time. If you're disciplined and follow your plan and kick out your losers or the trades that don't follow through, and then just re-enter because it's still a good idea, welcome to the elite club that finally gets it. Expect it. And if it doesn't, just say fine. Just ask yourself, and that's a key observation you'd write down in your journal, would I take that trade again? If the answer comes back yes, then look for another spot to get in. So that's a really good question, Mike.
Okay, perfect. And then also, you're using the 8 and 21 moving averages. Any specific reason why you're choosing those time frames, those periods?
Yeah, they're actually Fibonacci numbers. And Evan Lazarus, who's a little under the weather today, who wrote the Active Trader Manual for T3 Live, he believes very strongly that these numbers are significant, and we're finding out that they are. They're very consistent. Now, I've seen many traders, they'll use the 10 and the 20, they'll use the 5 and the 15. It's a very, very good question, but here's how I'm going to answer it. Whichever ones you decide to use those same ones all the time. And it doesn't matter if you're looking at a 1-minute chart, 15, or a weekly chart. Keep it consistent so that you have a significant reference point that you believe in. Okay?
Okay, thanks.
All right, so moving along now. One thing I want to discuss here, in this particular setup that we're going to talk about, it's a capitulation buy setup. I'll just read the definition here real quick. Scenario where an oversold stock falls at an unsustainable pace. Now, this is actually a very good scenario to discuss today based on how the market traded today. Whoever is looking at the market today, we came in pretty hard today, okay? No matter what we're going to show you right now, you still, no matter what, the same way I said before about using moving averages and anticipating something happening, but then not doing something until the candlestick actually shows you the price action has given you some sort of bottoming tail or pivot low, as we call it in our vernacular. The scenario is one thing, but then you still need a clear tactic to get in. Okay, now this is an advanced setup. It's a setup that you should use if you've proven to yourself over time that you have the discipline that if a trade is not working, you're very disciplined to get out of it. Very, very important there. So we have oversold very quickly and creates a sharp reversal bottom. So we have a whole bunch of different things that go in there. Now, here's the mistake that traders make. They'll only put in like 1 or 2 of those pieces of that sentence. All of the pieces of the sentence need to be a part of it in order for the play to actually be the scenario. So the second part here, the moment of irrational price action due to extreme emotion. So just the fact that irrational, extreme, oversold, sharp reversal. What does that tell you? It's a little bit more of a volatile play. It's a play that you have to really, strap yourself into your seat and say, okay, this is a trade it's got a little bit higher reward potential, but I really got to be on top of my game to be putting this trade on. And I'm actually going to add a little bit to the end of this after we go through the requirements for the trade. All right, first, vertical price action. So this thing is going boom, straight down, extreme price separation from the moving averages. And actually, just there's a couple of stocks actually that fit this criteria that you could find on today's in today's window on the daily charts in the market. Extreme price separation from the moving averages. Now, the question that comes back is, well, what's extreme price moving? Is it 5%, 10%, 7%? Use your gut. Get a feel for the stocks, and if you know your stocks, you will get a feel for what's extreme for that stock. That's something very important for traders to learn. Know how your stocks normally trade, and you should know when they're trading well versus, wow, I can't read this thing to save my life. When you understand that about your stocks, that's when you get to the point where you minimize your mistakes and you ultimately end up being able to take advantage of when a stock is quote-unquote doing what it's supposed to do. Part 3, the bodies of the candles grow in size. So in this case, we're going straight down, and the bodies are big red candles the further it keeps moving down. Volume is increasing with each bar as it's moving down. All right, now actually we have here often has peak volume on the last bar of the move. I'm going to throw it out there. Does anybody know why more often than not at the end of this move there's a huge volume spike? Now I can't see the answers, Mike. If anybody types it in, let me know. The reason there is a huge volume spike at the end, more often than not, and I've worked with a lot of specialists and market makers over the last few years. Think about it. What causes a stock to move really fast, really quick? A big institutional order. So what ends up happening is it's getting pushed down, pushed down, pushed down, pushed down. Now the institution only has X amount of shares left, and they know they're the person who's pushing that stock, in this case, down. What they will do is they will negotiate a price with either a market maker or a specialist. Say, look, I got 250,000 shares left. Give me the print on the whole thing, and I'm done. And that's where that big spike comes from. So in the professional trader vernacular, that's called a cleanup print. A cleanup print. But you see it on the chart as that one big volume spike.
And we actually had the right answer coming through on the chat, so perfect.
Awesome. Awesome. Very good job. Very good job. All right, so the technical trigger would be if you get a big bottoming tail after or at where you get that big volume spike, and that's where you start to anticipate looking for the entry. Now, you don't just jump in because of that. You know, you get that little, what we call launch echo, where it skids a little bit past there, but clearly is near the bottom. You want to wait for price action to bottom and then have some reference point, which is we're going to talk on right now. So the buy action for this here would be enter on any technical trigger long. So we're going to put it in the context of what we're talking about now to give ourselves that little bit of confirmation, that little bit of conviction. Wait for it to take out the previous candle's high. So if you get that big spike down, that big capitulation volume, wait for it to take out the high of the previous candle, just so you give yourself a little bit of confirmation. So you'll have the price moving in your direction as well as having a very significant reference point to manage your risk. And again, managing your risk is the key there. All right? The stop loss should be under the low of the sell-off, or whatever happens to be the bottom of the candle where you feel now we bottomed out and I could get involved. So one little tip here, they typically offer a very favorable risk-return ratio. Now, I'm actually going to put it a little bit further there. A very favorable reward potential. As long as you're disciplined to be confident, I have a good risk point. You want to be sure that you have a good risk point, and if it doesn't follow through, that you know where you're bailing on the trade. So we're pushing down, pushing down. You can see here what's very interesting. We have everything we just discussed. Candles getting bigger, pushing very quickly away from the moving averages, a big bottoming tail, and a massive spike in volume, which ultimately represents that cleanup print and the spot where we would look to start putting that position on. And actually, I want to point out something, too, which you might want to write down, because this is actually a unique spin on this that I teach to everybody in the private group. Obviously, if the stock is trading like this and the stock pushes down, everybody knows from classic technical analysis, trade pushes down, pulls back. The next trade, the proper trade, is to short sell the pullback, right? Big down move. You want to be a seller. In this case, you want to be a short seller. What I want you to write down is when you see a capitulation buy or sell, and it's obvious, the odds of making a new high or new low are diminished. So in other words, short selling the next move, in this case, after a capitulation trade, is not a high probability short sell. I don't have any hard and fast statistics, but go back to the charts, you'll see it's just something I know from a lot of experience. All right, so another example here. Different stock. We have WellPoint again, this time on a 5-minute chart. And actually, if I can give you one more heads up that you probably want to write down. Capitulation, price action, and volume. For whatever reason, I don't know why, but in my opinion, it's a fact, is much easier to spot on a 5-minute chart and a daily chart. Probably because you're getting that cleanup at the end of the day or the capitulation volume at the end of that 5-minute window, which actually is probably from that one big print. So it's just easier to spot on a 5-minute and a daily chart. All right? So you can see here clearly T3 climactic long met all of the requirements. Larger candles, fast move away from the moving average, huge spike in volume, big tail on the bottom. You enter at the top of the one where you get the big tail, so you have a clean entry signal, clean stop loss, and your first target would obviously be the 8-period moving average, with the 21 being a little bit deeper and a much better reward potential there. All right, one more here. Same exact setup. The interesting thing here is when you start to see this happen, we talked about the risk, we talked about the entry. Now you get to the point where there's two other things that you put in here. You see in the little box on the left there, the capitulation here actually occurred at a higher time frame support level. So if you see capitulation at a level on a higher time frame that's a significant support or resistance level, you can probably go in a little bit more aggressively because of that support or resistance. But the point I was making before, on the way back up after the capitulation, those same moving averages that you were leaning on the way down should be your first targets in the direction that it's moving now, which is in this case to the upside. All right, Mike, that's actually the end of the presentation. We can actually take some more questions if anybody has them here. What I do want to offer to everybody, though, is at T3 Live, we actually have a 30-day online home study course that if anybody would like to enroll, absolutely complimentary, no cost to it at all. The first 10 lessons alone are 8 hours of video. So if you weren't tired of hearing my voice today, you'll definitely be loving my voice after those 8 hours. So we highly encourage you to get in there. No cost whatsoever. The URL on the top there you can see is t3live.com/edu. So we can open it up to some questions there, Mike, if you got some more.
Yeah, we got one or two here coming in, and again, if anyone has any questions, please go ahead and type them in now before we wrap it up. So one of the questions is, are you ever using the candlestick patterns as a momentum indicator?
Yes, actually, it's interesting. I actually use them both in the stocks themselves and when I use the VIX on an intraday basis. It's actually interesting because a lot of people use the VIX as obviously the fear index and whatnot, but I actually take it a step further on an intraday basis. When the size of the candlesticks on the intraday VIX chart start to increase, I use that as an increase in momentum. So not only am I using the VIX as a long or short addition to my argument for my idea, when the VIX candles start to increase, the volatility is increasing, which also helps me to very cleanly expect to hold the trade for a little bit longer. So if you really even go down to a micro level, even more than that, if you really think about it, if the ideas are coming from the bigger picture, each individual candlestick is momentum, really, because momentum is the price action on a very short-term basis. So one candlestick by itself actually is the momentum.
Okay, great. And then we have a question. So there's some Lightspeed specific questions coming in. Some of them I'll just take offline so we don't have to take up too much time on the webinar. But basically, if you're not currently a client and you want to check out our platform and the other services that we offer, you can just go to lightspeed.com and our homepage is a demo request button. And one of our sales reps will be glad to send you a demo and go over the platform with you. And some more questions coming in about the actual presentation, being able to view it at a later date. So yeah, as I mentioned in the beginning of the webinar, if you go to lightspeed.com/webinar, you will see an archive of all our past webinars, and then this one is also being recorded, so we're going to have that up there within the next day or two. So you'll be able to go back and review it and check out the slides if there's anything that you missed. And I think that's pretty much it. So Pete, thank you so much. This was a really great presentation. Getting a lot of positive feedback already on it. I hope we can have you back in the future to do another one for us.
Absolutely. Just reach out to us. I'll be more than happy to get involved. Have a great night, everybody.
Sounds good. Thanks, everyone, for joining us. Have a great night.